Hi, everyone. Welcome to your latest Carson's Take 5. Ryan and Sonu here. Sonu, we'll talk about where you are in a second because it doesn't look like Chicago. We're going to talk about inflation, right? Are tariffs causing inflation? Got some interesting data that just came out. We're going to dig in. But before we go there, Sonu, you've got a nice hat on. Where are you?
Yeah, I'm in Zion National Park. So here it is, to give you a sense of my surroundings. Right next to the entrance of Zion National. I've been touring Utah and Page, Arizona. So we went to Moab, Arches National Park, Canyonlands, then Antelope Canyon, which is all of it spectacular. Yesterday, I did some bouldering. I didn't even know what that was. It was a lot of climbing. So every part of my body.
It sounds dangerous
right now. We had a good guide, but it was a lot of fun. It was a lot of fun. More fun for my kids. And you just realize, when you do these things, how old you are. But here I am. I've survived.
Yeah. Well, we were out there in April, that part of the world, and you realize how big our country is and how
Totally.
there's not people everywhere, is what I'm getting at. It's just a lot of desert and a lot of beautiful mountains. But listen, let's get to it. This week was all about inflation, right? That's why we're going to focus on inflation. Sonu, we saw called the CPI, the consumer level prices, but then also the PPI, the producer level prices. Now, the way I learned it, and here's my question to you. They say if inflation is going to show up, it'll start on the producer level, then work its way to the consumer. Because we had good, I'm using air quotes, everybody, good consumer inflation, but the producers seem to kind of shake things up a little bit. What have you found in those two really important data pieces this week?
But there are three ways tariffs get passed on, right? And who pays the tariffs? We know somebody's paying the tariffs because the government's collecting a lot of tariff revenue.
That would have been a good title also. Who's paying the tariffs? Maybe we'll do that some other time. That's another good title for one of these.
Yeah. And we know from the import price data that it's not foreign exporters, at least not a major chunk of it, which means somebody on the U.S. side is paying it, whether it's U.S. businesses or U.S. consumers. So far, it looked like it was U.S. businesses because tariff costs didn't seem to be passing through to consumers just yet in a big way, right? But with today's producer price index, what that's telling us is that the producer price index is hot, but it doesn't quite measure input-output prices, right? Because wholesalers, retailers, what do? They don't change the product that they're selling. They do, all sorts of promotional stuff, bulk breaking, they place things on the shelves so that they look pretty and nice, all of that, right? What producer prices measure for retailers and wholesalers is margins. And margin prices have gone up. Now, that's not a bad thing in your and I line of work because margins going up boost stock prices, right? But it also means producers think they can pass costs on to consumers, and that's what we're seeing. So ultimately, I think this tariff situation, tariff costs, are going to be priced into, consumer goods.
Yeah, and again, this week we saw the consumer level inflation, which didn't quite show that coming yet. But again, we're watching it very closely. Let's kind of take this to part two. The Fed, right? The Fed, we were on record on these very videos earlier this year, probably should have been cutting. They didn't cut. Then tariffs came. They had to kind of wait. They're still kind of pushing back, but the Fed funds futures. That's what the market says. And a lot of other Fed members are publicly saying this Fed should be cutting. Scott Bessent yesterday, Treasury Secretary, said 1.5% cuts this year is what he thinks they should do. So, yeah, listen, we'll see on that. But the reality is, before the producer prices came out this morning, the time we're recording this, it was like a 99% chance of at least a 25 basis point cut. That dropped a little bit, but it looks like September, even after this PPI came in hotter, September's probably going to see a cut, right?
Maybe.
I wouldn't maybe pushing against it. Yeah.
I wouldn't, say it's a 90% probability, maybe 60, 70% chance, which is still odds favor a cut.
Okay.
Sorry, there's somebody with a machine rail next to me, so hopefully you can still hear it.
I can hear you, yeah.
Anyway, I think the Fed does have a bit of an inflation problem on their hands.
Yep.
And what the consumer price index showed is that yes, tariffs are causing some inflation. It's not a lot. But if that was the end of it, I would say, sure, yes, you're going to get a cut. But what it also showed that services inflation is peaking, right? Services inflation is starting to reaccelerate. Now, we don't know if 1 month doesn't make a trend, but there's enough in there to cause it worries. And, you look at core CPI, consumer price index, excluding food and energy, that's running at 3.1%.
Right.
And here's a stat for you. The Fed has never cut rates when the core CPI has been above 3%, except
Wow.
back in 1989. And
Okay.
at that time, the Fed funds rate was 10%. They were coming down from 10% down to 9 and 8 and 7 and 6. That's the only time core CPI was running
Wow.
above 3%. They have never cut below that. So the optics of them cutting in September doesn't look that great when inflation's going the other way from their target. So that's why I'm not ready to say that, oh, yes, for sure, we're getting a cut in September. We have one more inflation print, by the way. Speaking of cuts, when we came into this year, we were like, the Fed should cut. Why? Because, productivity growth was strong, output was strong, the GDP growth is running about 3%, the labor market is okay, and inflation is cooling. Now we have an uncomfortable cut, let's say. Output growth is cooling, right? GDP is not growing as fast as it was last 2 years. The labor market is cooling, and inflation's going the wrong way, right? We may still get a cut, but like I said, it's an uncomfortable cut.
No, very interesting. One thing that I know we talked about a year ago, because the Fed did its first cut last September, and they did another one later in the year. I believe it was November. Both of those cuts were when the stock market was near all-time highs. We noted back then 20 times, back to 1980, I found where the Fed cuts interest rates with the S&P 500 within 2% of an all-time high. So we're going to call that close to an all-time high. 1 year later, higher 20 times. Now, there's a very good chance this September, 1 year from the cut last September, we're going to be higher. And maybe by November, we're probably going to be higher too, the way the market looks. So, there's the old saying, don't fight the Fed. I guess, there is that still, but with inflation showing pockets of coming back on the producer level. And again, one more thing, Sonu, I know we're kind of getting near the end of this latest Carson's Take 5. We hear the big argument appears to be tariffs are a one-time kind of tax, if you will, one-time jump, or people think it's going to be extended higher prices over time, which by definition is inflation. I mean, where do you side with that? Are we just seeing the one-time jump in prices right now and maybe one more month and it's over? What do you think that'll shake out?
By itself, tariffs should be a one-time jump. Part of it is we don't know where tariffs are going to end up, right?
Okay.
It was one thing, tariffs were one thing in April, it was another thing in May, it was another thing in June, it's a whole other thing in July. August is a total different thing. So there's a whole level of uncertainty with respect to what the tariffs are actually going to end up being. But then you get into measurement issues, right? By itself, yes, tariffs should be a one-time increase. But the way things are measured, you and I know that it's not going to show up as a one-time increase. It's going to show up as a progression of increases over the next 3 to 4 to 6 months even. But like I said, goes back to, one thing I track is restaurant prices, right? I've been eating at a lot of restaurants here. That is a good gauge of how strong underlying inflation is. Over the last 2 years, we've talked about this before, that's been coming down, that's decelerating. But over the last 2, 3, 4 months, that's been reaccelerating. And part of me thinks that when looking at that data, underlying inflation is still on the stronger side, and the Fed's inflation problem still exists. But the question is then, is 3% inflation the new 2%? Right?
Yes, exactly.
Implicitly, have they changed the target? I think that is a big question.
Well, we can get into all that stuff later. And then don't forget, later this month, I don't remember the exact date, but Jerome Powell goes to, that's where you kind of are, out in Utah, right?
Not far from me.
What's that called? I just went blank.
Jackson Hole.
Thank you. I just went blank. Sorry about it. Jackson Hole, the annual Jackson Hole Symposium. And again, we'll talk about that in a couple of weeks when it happens. He'll give likely a very clear guidance of what he's probably thinking in September. But as of now, the market at least is saying there's going to be another rate cut this September. So with all that, everyone, this is your latest Carson's Take 5. Ryan from his office and Sonu on location out west. Are tariffs causing inflation? See you by next week. Thank you. Take care.